In a world where every transaction seems to happen at the click of a button or the swipe of a card, have you ever stopped to wonder about the origins of the very thing that makes these transactions possible? How did the concept of money shape and reshape empires, trade routes, and entire civilizations throughout the annals of time? Join us on a captivating journey as we delve into the intricate and fascinating tapestry of human civilization, exploring the roots and evolution of the lifeblood of our economic systems. Money, in ancient times, barter trade involved direct exchange of goods and services. Without money, it had limitations, notably the double coincidence of once requiring both parties to desire each other's items. This perfect match often led to inefficiencies. Over time, societies recognized these limitations, prompting the adoption of money as universal medium of exchange. Currency addressed the challenges of barter systems, eliminating the need for a perfect match and greatly enhancing trade efficiency. As societies expanded, the need for a more efficient medium of exchange led to the use of commodities with intrinsic value as money. Cattle, salt shells, and precious metals like gold and silver served this purpose in various cultures. Gold and silver, in particular, gained widespread acceptance due to their durability, divisibility, and portability. Their intrinsic value, rooted in rarity and aesthetic appeal, solidified their role as valuable mediums of trade. This use of precious metals played a crucial role in developing sophisticated economic systems, providing a standardized means of transactions. Eventually, these metals laid the foundation for modern currency systems and the establishment of complex financial markets. From the 7th century BCE through the Middle Ages, a significant development in the evolution of money occurred with the introduction of standardized metal coins. Unlike earlier commodity currencies, governments and rulers issued these coins typically made from precious metals like gold, silver, or copper. The key distinction was the guarantee from the issuing authority regarding the coin's weight and purity, establishing trust and confidence in their value. The shift from commodity money to representative money marked a crucial step in currency history. Standardized metal coins facilitated more efficient trade by providing a universally recognized and easily transportable medium of exchange. This era laid the foundation for modern monetary systems, where currency often represents value and is backed by trust in the governing authority. In the 7th century, paper money emerged in China during the Tang Dynasty, a departure from reliance on metal coins. Chinese merchants adopted paper notes as a medium of exchange, and this practice gradually spread to the Middle East and Europe. As the use of paper money expanded globally, governments played a pivotal role by backing these notes with promises of exchange for precious metals like gold or silver, enhancing trust. This marked a significant evolution in the history of money, shifting from commodity-based or precious metal-backed currencies to representative forms such as paper currency. The widespread adoption of paper money paved the way for complex financial systems and laid the groundwork for modern banking and monetary structures. In the 17th and 18th centuries, a transformative phase in money's history unfolded as banks began issuing convenient banknotes, departing from precious metals or metal-backed paper money. Banks played a key role by introducing these notes, paper currency issued by financial institutions, offering increased convenience for transactions and becoming a gradually accepted medium of exchange. Concurrently, the fractional reserve banking system emerged, enabling banks to lend more money than held in reserves. While simulating economic activity, this practice introduced risks, allowing banks to create money through lending and heightening the potential for financial instability and crisis. The combination of banknotes and the fractional reserve banking system laid the foundation for modern banking and monetary systems, marking a departure from commodity-based money and emphasizing trust in the financial institutions issuing these innovative forms of currency. In the 19th and early 20th centuries, the gold standard emerged as a significant monetary system adopted by numerous countries. In this system, currencies were directly tied to a specific quantity of gold. Under the gold standard, a country's currency value was determined by a fixed exchange rate, with a set amount of gold, aiming to bring stability to the monetary system and inspire confidence in the currency's value. The public could exchange their paper money for a predetermined amount of gold, reinforcing trust in the currency's intrinsic value. while the gold standard provided stability and had drawbacks. The link to gold limited the flexibility of monetary policy, especially during economic downturns, as governments had restricted ability to adjust their money supply in response to changing economic conditions, potentially worsening recessions after World War II. The Bretton Woods Agreement of 1944 reshaped the global monetary system, linking major currencies to the US dollar, which was convertible to gold. This arrangement aimed to stabilize the post-war global economy, making the US dollar a primary global reserve currency. Other major currencies were pegged to specific rates against it, fostering confidence in currency values and promoting international trade and finance. However, economic imbalances and U.S. trade deficits led to challenges. In 1971, President Richard Nixon, facing pressure on gold reserves and inflation, suspended the convertibility of the U.S. dollar to gold, known as the Nixon shock. This move effectively dismantled the Bretton Woods system, concluding its era and ushering in a new phase in the international monetary landscape. Currencies transitioned to freely floating against each other, abandoning fixed exchange rates. This shift marked the beginning of the modern era of flexible exchange rates and fiat currencies. From 1971 onwards, a significant shift in the nature of money occurred with the widespread adoption of fiat currency. Unlike commodity-backed money, fiat currencies, including digital ones like Bitcoin, aren't tied to physical commodities like gold or silver. Instead, their value derives from government regulation and the trust of the people using them. Money stability relies on the confidence of individuals and businesses in the issuing government. Stability and integrity. Governments have the authority to issue and regulate these currencies, granting greater flexibility in managing monetary policy. This departure from commodity-backed money liberated governments from the constraints of the gold standard, providing them with more tools to navigate economic challenges. From 2009 to the present, the evolution of technology, particularly the internet and blockchain, has given rise to digital currencies. Bitcoin, introduced in 2009, marked a pivotal moment as the first decentralized cryptocurrency, fundamentally altering the traditional concept of money. Cryptocurrencies, based on blockchain technology, offered novel possibilities for financial transactions. The decentralized and secure nature of blockchain enables transparent and tamper-resistant record-keeping, potentially revolutionizing the efficiency and inclusivity of financial systems. Despite these advantages, the ascent of cryptocurrencies poses regulatory and security challenges. Governments and financial institutions grapple with creating frameworks to regulate and integrate these digital assets into existing financial systems. Ongoing discussions address concerns about potential misuse or illicit activities and the security of digital wallets as the digital and cryptocurrency landscapes continues to evolve. Its impact on finance technology and regulatory frameworks is poised to change the future of monetary systems and financial transactions. If you found this exploration into the analysis of currency intriguing, don't forget to like this video, subscribe for more captivating content, and hit the notification bell to stay updated on our upcoming historical journeys.